Good day, viewers. This video is merely to give context on how this particular topic in accounting made principles of accounts easier for me, and I just want to pass that on to you as students to give you some context when preparing for your accounts paper one. Now, this topic that I want to highlight is in the form of classification. Now, within the definition of accounting, when you visited the definition of accounting, somewhere in that definition, you must have saw the word classification. Now, we're going to look at how to interpret or how to classify certain things in terms of accounts and the different types of classifications in accounts. Now, the first classification that I want to look at is assets. Now, we know that assets is things owned by the business. So let me repeat that. Assets is things owned by the business. Now, how are assets affected? Now, remember, when visiting the double entry system, each debit entry needs a corresponding credit entry and vice versa. Now, when recording a transaction, using a T account. Now, when recording transactions, you need to know what type of classification these accounts fall under. Now, the first classification is that it can be a form of asset. Now, remember, assets is anything owned by the business. So let's take for instance a bank account. That is an asset because you have money, you have a business money in the bank account. Now, how are assets affected? Now, assets are affected in that assets are increased on the debit side and assets decreases on the credit side. So let's take for instance you have a bank account. And John Brown paid you $5,000 by check for goods that he bought on credit. Now, let's say you're just starting a business and you have $0 in the bank account. But when John pay you, you now have $5,000. That's an increase. So we record that increase on the debit side of the account, because that's an increase in assets. Because we don't classify bank or your bank account as being an asset. So let's say out of that same bank account you paid wages by check valuing $2,500. Now, paying that $2,500 will decrease the amount that you have in your bank account. Now, remember, we said that bank account is an asset. Now, how do you treat reductions in asset? You treat them by recording it on the credit side of that account, because any decrease in asset would be reflected on the credit side. Now, let's take the second classification, which is in the form of something we call liabilities. Now, liabilities is things owed by the business. So whether in form of loans, short-term loans, long-term loans, whether it be goods that you buy on credit, so therefore that person becomes your creditors, those are people that you owe. So therefore they will be classified as liabilities. Now, it's important to note that we decrease in liability on the debit side and we increase in liability on the credit side. So let's say you bought goods from Wysinco on credit. So you buy goods from Wysinco on credit. Now Wysinco becomes a creditor because you owe Wysinco for that goods that you bought on credit. Let's say that goods amounted to $3,000. we will record that $3,000 on the credit side because we increase in liability on the credit side. Now let's say after we take that goods, we pay Wysinco $1,500 at a later date. Now that would decrease the amount that we owed Wysinco. And any reduction in liability is done on the debit side. Now let's take capital, which is normally an account that is recognized when doing transaction. Because a capital account is money or any assets that the proprietor used to start the business or used to run the business. Now one might ask, how can we increase in capital and how can we decrease in capital? Now first, just like liability, we increase in capital, we decrease in capital rather. So let me start that over. We decrease in capital on the debit side and we increase in capital on the credit side. Now, how are ways in which we can increase and decrease in capital? Now, net profit. Now, if you make a profit, that can increase your capital. Because if you're familiar with the classified balance sheet that we'll be running through in these short videos going forward. But for now, for argument's sake, we know that net profit increase in capital. Because when you look at the balance sheet, it is always the capital at the start plus the net profit. So that automatically increase in capital. Now we record that net profit on the credit side of the capital account. Now let's say you made a loss. Let's say you made a loss. Now that net loss would be recorded on the debit side of the capital account. Reason being, that loss would decrease the amount of capital that you have at that point in your accounting period of the business. It will decrease the capital because when you go back to your classified balance sheet, capital with a net loss would automatically decrease your capital. So therefore we treat that decrease in capital on the debit side. Another way you can decrease in capital is through drawings. Because also in the finance by section of the classified balance sheet, it is normally capital plus net profit minus drawings. Now drawings normally have their separate account, but we record drawings on the debit side. Now why do we record the drawings on the debit side? Because why? Drawings decreases capital. Now what is drawings? Drawings is when the owner takes money or other resources for personal use.